Hello, everybody, and welcome to the Like Totas channel. Happy to have you join us, dear viewers. Thank you so much for all the support that you guys have been sending to the channel and all the messages that you guys keep sending, and also your comments. That really makes every single one of my days. We had an amazing live session on Friday again, and hopefully, those of you who did manage to join just did manage to learn a ton, and hopefully that was insightful, and that's exactly what I want with these monthly calls. Of course, I want to see as many of you there so I could just share as much value as I possibly can, and hopefully we will all benefit down the line. Okay, so thank you so much for that. Guys, today's video, and hopefully, of course, you all had an amazing weekend and did manage to relax a bit after the last few weeks of stock market volatility. But as far as I'm concerned, as you guys know very well, I always love volatility, especially when it's to the downside. It's exactly during those moments of panic that we, like a tortoise type of investors, thrive. Okay, and that's what we're here for. Now, guys, today's video is specifically dedicated to those of you who might be busy but don't really have the time to commit to actually doing some research to identifying quality stocks. And that is exactly what my entire framework has been built around. Because in case you didn't know already, I was once a busy high-income professional as well. But what it happens is that most investment and trading strategies really require us to be more. Well, it requires us to be. It's impossible to succeed while still having a full-time job. That's what I mean. Because many of them require us to be a lot more hands-on, right, with the investment process. But fortunately, over the years, and based on all my mistakes and all my education, I did manage to come up with a strategy that I refined over the years. And this definitely allows busy professionals to thrive. That means beating the market averages over time with minimal work, while building a portfolio, while building a concentrated portfolio of high conviction companies. And so this video is for you guys, okay? It will help you a lot because I will be sharing, stay with me for the next few minutes as I will share the entire framework of what allows us to succeed in the markets over time. And I want to be very clear and transparent with every single one of you watching this right now. This here has been, from a performance standpoint, we are lagging the S&P 500. I want to make that clear. In fact, most investors that I know are definitely underperforming the S&P 500 this year. And look, does that make sense? It does make sense because even though the S&P and the Nasdaq are slightly below the all-time highs, we can see that many companies that are within these indexes are trading 50, 60, 70% below the all-time levels, right? And so, yes, because we own a concentrated portfolio, all it takes is one or two companies to get hit on a short to medium term basis for the performance of the portfolio to come crashing down. And that's what we are seeing this year. Now, does that upset me? Not one bit. That's how the expression goes. And the reason for that is very simple. As I already told you guys in a previous video, we own fundamentally stronger companies that are trading at significantly lower valuation levels. Okay, so I created a video on that not that long ago, which I'm sharing right here with you guys before we jump into the main topic of today's video. And you can see that based on several metrics, you can see the metrics of our Like a Tortoise portfolio versus those of the S&P 500. So the companies that comprise our portfolio have better capital allocation metrics, right, in terms of ROIs and ROI, so return on invested capital and return on shareholder equity, right? Which means that our companies deploy capital more efficiently compared to the average company in the S&P. In addition, from a profitability standpoint, our portfolio holdings are definitely more profitable than those of the S&P 500, right? From a margin standpoint, as you can see right here, they have also grown historically more attractively compared to the S&P 500. Look at the revenue, the 5-year CAGR for the average company in our portfolio, 16% versus only 6.30% for the S&P 500. This is staggering. In terms of earnings per share, oh my God, take a look at this contrast. Okay, so, and not only that, not only do we own fundamentally stronger companies, but they are also trading at comparatively lower valuation levels, especially on a forward PE ratio. And this, ladies and gentlemen, is the recipe for long-term investing success. Okay, and those of you who actually take this framework and start building your portfolio around these things, these principles that we discuss here at length, you will make a lot of money over time. You will have 1 year of outperformance in 3 out of 3 years, but the question you have to ask yourself, if you have a 10, 15, 20-year investment time horizon, are you okay with underperforming 30% of the time when your average of over time is going to be around 20%, even higher than that perhaps? Yes, of course, you would take that every single day. And so I am definitely not an exception to the rule. I would take that every single day, and I'm very convinced that over time we will continue to outperform so over the long term. Okay, so guys, for all of you dear viewers who are busy professionals and don't have as much time to commit to doing stock analysis research as you would love to, this video is for you. So let's talk about that. And what I have right here, as always, and by the way, guys, if you are finding this video valuable, just please make sure you smash the like button, because it really helps us grow. And that's going to be the purpose, because it means we will be able to continue to create more videos and provide more free value. Okay, that said, and I just want to say as well, look, the last few months have been absolutely amazing, and many of you watching these have also become clients, and we have so many of you that have been providing us with great testimonials over time. You can see right here, I'm sharing the screenshot. These are some of you in some of our coaching lessons, and this has been fantastic. So over the last many months, we've had many coaching calls and the calls with other quality investors, and these have been fabulous because they really make Like a Tortoise meaningful, and that's what we want to continue to do going forward, right? To be as transparent and to be able to create as much value as we possibly can. So thank you once again. All right, let's talk business. And as always, I put everything nicely in a PDF. So make sure that you pay attention, right? It took me a while to put together this PDF, as it's normally the case. In fact, it's not this one, so bear with me 1 second. Where is the PDF? Right here. Okay, awesome stuff. And so I'll start. Yeah, I will start by sharing this with you right now. Okay, so let me pull this up. Yes, right here. Okay, so how to build a 10-15 stock portfolio in 180 days, which is to say in about 6 months or so. Now, pay attention to that, guys, because this is not just any portfolio. So many of you watching this are probably saying, oh my God, do I need 6 months to build a portfolio? Guys, the goal is for you to build a high conviction, high quality stock portfolio of 10-15 stocks that will set you up for great outperformance over time. It's not just a standard portfolio, and for that reason, yes, it will take a bit longer because you need to make sure that you have the right foundations in place. Okay, and many of you, based on the feedback that I've collected over time, and also judging by your questions that you make whenever we have our live sessions, the problem that you are having right now is a lack of structure. You don't have a solid framework, okay? And that's what I want to discuss here as well. We don't need more than 15 companies in our portfolio. In fact, you shouldn't even have more than 15 companies in the portfolio, because after that number, it becomes harder for you to outperform over time. It's not impossible, it's just harder, right? Because you are spreading yourself out too thin, and by doing so, you are guaranteeing the average rate of return. So we want to build a portfolio of no more than 15 stocks that you understand very well, all right? And you want to we want to do that in under 180 days. So let's talk about the steps that I would personally take today, right? If I hadn't built my portfolios yet, okay? Step number one, define your strategy. That should be week 1 or 2. Clarify your objective. And your objective, if you are following this channel, I assume that is long-term compounding. So you are not here because you want the next stock tip. That's not what you want, right? You want to take your financial you want to take financial matters into your own hands. You want to be in control of your financial future instead of relying that future to somebody else, to a financial advisor, for example. You can do that even with a full-time job if you follow this framework. So pay attention. Target 10, 15 high-quality businesses. That's it. 10, 15 high-quality businesses. Your time horizon should be, I would say definitely say 10 plus years. So we are talking decades, not just a few handful of years. Avoid speculation, trends, and hype. The outcome, you know what you are looking for. You have to understand the meaning right here, guys. Okay. So build step number 2, build the high quality watch lists. That would happen within week 3 to 6. What you will find is that you will come up, there are many companies that can fall. So you can use a stock screener to come up with a list of say I don't know 40, 50 companies that meet your criteria for quality, the criteria that we typically discuss on this channel at length as well. And that includes gross margins, returns on invested capital, past growth rates, future projections. Based on this criteria, you can easily come up with a list of high quality companies that match that specific criteria. Okay, and this is something that I teach my clients to do. And so not so you're going to have 15, 14 companies, so 40, 50 companies across different sectors and industries, all high quality. And by high quality, I mean excluding some industries altogether. As I already told you, the Likert tortoise framework is not applicable to industries that are very capital intensive, because of the inconsistency and unpredictability in the numbers. I don't like that. That creates uncertainty, so I exclude them altogether. What you want is, once you have that bigger list, you want to identify 20, 30 companies across sectors, because you still will want some level of diversification, right? You don't want to have 15 stocks all in the same sector or 2 sectors. Because if those sectors get clobbered, as we are seeing today with healthcare or consumer discretionary, you are going to be in panic mode. Okay? So, yes, diversification across sectors. Focus on strong business models, durable demand, industry leaders. And I told you, so what we do when we do this with my clients, what typically happens is they end up with number 1, 2, or 3 companies in their respective industries. Okay, and it makes sense because of the quality criteria that we are using. Think software, healthcare, consumer brands, niche leaders. The outcome, you will have a curated list of potential winners. Step number 3, start analyzing competitive advantages. That is the moat. Everything we do, every investment decision that we make is built on these 4 steps: meaning, moat, management, and margin of safety. Meaning, you have to understand exactly how the company makes money and whether you have an edge here, whether you understand its business model, its revenue streams. So if you understand the competitive landscape, and so all it takes, guys, is just about 1 hour of your time per week in order to do a fabulous homework. You don't need more than that, but you will need consistency. Okay, you will need consistency. First, you follow these steps, and then based on my own experience over time, all you need is about 1 hour per week, and you can absolutely beat the market over time following this structure. For each company, you will assess pricing power, switching costs, brand strength, network effects, cost advantages. Okay, so what is the moat here? Or is there a combination of moats? Those are the questions you can ask. And right now, with ChatGPT, with Gemini, it's so much easier to come up with a strong answer for all these questions that we are highlighting right here. All right. Key metrics you are looking at for ROIs, margins, and revenue consistency. This is very important. The outcome, you will filter out weak businesses. The step 4, you will evaluate management quality. The questions you should ask revolve around, are they capital allocators or empire builders? Okay. Do they reinvest wisely? Are incentives aligned? In other words, skin in the game. Not many companies will meet this criteria. And so your investable universe will get very narrowed the moment you start throwing in all these essential requirements. You are looking for share buybacks, rational acquisitions, consistent strategy. You are also looking for managers who typically have a lot of their own wealth tied into the company, right? You trust who's running the business. That is the outcome. Remember, what we are doing right here is building conviction. The more conviction you guys build, the less prone you will be to making emotional decisions that will disrupt your portfolio returns over time. Step number 5, focus on financial strength. That is moat plus management. Check revenue growth, earnings per share growth, free cash flow, debt levels, margins. There are so many financial metrics out there. I want you to make it a lot more simpler than many people want it to be. Because successful investing is simple, but not easy. The reason it's not easy is mostly down to temperament. Okay. Avoid highly leveraged companies. I still see many of you asking me questions about companies, for example, that are not well established. If they are not well established, they will have inconsistent earnings, right? That's what we typically see. Not least because many of them will operate in capital intensive industries. Pay attention to that framework, right? Highly leveraged companies, make sure that the companies that you own produce real cash flows that can cover all the debt in a short period of time. That's what we want. The outcome will be financial resilience. All right. Step number 6, determine intrinsic value. Once you have your list of, say, once you have a core list of 20, 25 companies, you start determining the intrinsic value for each and every single one of them. And these companies already meet your criteria for quality, management, moat. But now you have to determine whether they are cheap relative to their fundamentals or expensive. That is what we are doing in step number 6. Estimate fair value using conservative assumptions, the assumptions that we discuss here at length as well. Don't aim for precision, aim for a range. Compare with current price. The outcome is you know what's cheap versus expensive. And then step number 7, you start building your portfolio gradually. So now you are at a stage where you already have conviction in each of those companies. You have devoted at least 1 hour per week to studying these companies and building that conviction, right? And now you will start with highest conviction ideas and you will add positions over time. No rush here, because what you will see is that out of those 25, 30 companies that you have selected, many of them, in fact, if not the vast majority of them, will not have a margin of safety yet. Okay, those will keep on your watch lists, and then you will pay close attention to them. right? You can set reminders for your broker to send you an email once a certain price target is reached. That's what I do. Diversify across sectors. You will target 10, 15 stocks. Even if you have 25, even if 25 or 30 companies on your on that watch list, even if they are all at a buy price, you are not going uh, um, to start positions in all of them because you want to have some concentration and you don't want to own more than 50 stocks at any given point in time. Why do I say that, everyone? Exactly because this will help you. Remember, as a busy professional, as someone who probably has a full time job, right, and doesn't have as much time to devote to studying companies, the more companies that you own in your portfolio, the more attention you will have to divide across them. So the more your time will be required, and you don't want that, right? Remember, we are targeting at least 1 hour per week. That's it. And so you can't own more than 15 companies. Avoid over diversification, going all in too early. Step number 8, allocate capital intelligently. Higher conviction means larger position. Typical range is 5-15% per position. Portfolio should reflect belief, not randomness. Okay? Step number 9, stay disciplined, and this is ongoing. Review quarterly. Okay? So the only time, guys, you need to check in with your companies is when they report earnings, and that is just about frequently. That is enough. Other than that, you will pay attention to news that can really move the needle for the company. For example, if you see something that a company that you own, the CEO got sacked, yes, of course you will have to delve deeper into those news. But by and large, the only time you have to pay close attention and check in with your companies is when they report earnings. Again, that explains why you shouldn't own more than 10, 15 companies. All right? Ignore short term noise. A lot of you are still wasting a lot of time following daily headlines in market news. And then of course, you confuse that with the fact. So in other words, because you do that, you believe that then investing is too hard because it requires too much time. No, it comes down to the framework and structure that you are using. You are in this for the long term, and so any short to medium term noise is just noise that is there to distract you. You don't want that, so filter that out. You don't need that stuff. Your edge will be consistency plus patience. I told you, most of the time you do nothing. So this is perfectly possible with this framework. Core philosophy like a tortoise, slow deliberate decisions, high quality businesses only, long-term compounding, avoid emotional investing. And it's precisely because you are buying high quality businesses that you won't need to trade very often. Okay? Um, and I gave you a very good example. So the Leica Totus portfolio, I haven't sold a single position, a single share in 2.5 years. When I started the portfolio, that portfolio in January 2024. Yeah, in January 2024. Okay, that's it. Long-term compounding, void emotional investing. You don't need more time. You need a better system. This is my understanding based on the feedback that you have shared with me, based on my calls with my clients, based on calls with many of you over time already. And so this is the framework that I want you to steal, and I really want you to ponder this because it's so important. Okay. That said, this is what I wanted to discuss. In addition, a very thing that may help you as well, and just before we wrap up this video, is have a checklist with all the main things that you need to track for each and every single one of your holdings. I created something for our clients that I've already discussed here as well, and I can perfectly show you this right here. Let me see. Where is this? Uh, Where is that? Is it here? No. Where do I have that? Package. Let me. Yeah, unfortunately, it's not here. So bear with me. I thought it was here. Mm, no. Okay, so let me download it right here. Stock research checklist. Okay, it's right here. So this is what I'm saying, guys. Let me open this up. This is the research checklist. You can build a similar one if you want. Start with the basics because one of your question is, oh my God, but how do I pull everything together? It's so then I lose track of things. Tracking the historical growth rates of the company, the future projections, the moat, like the CEO, like what the CEO is doing with his own shares. So put everything together like section 1 basics, company name, stock symbol, section 2 quality management. Here you are breaking down meaning, circle of competence and conviction, right? And then you are populating every single one of these spaces, and that you will have a checklist for each and every single one of the companies that you own, and this is where you will refer to whenever you want to whenever you want to analyze the company that you made an investment in again. Okay, you will have everything combined here into a single document, and this will make your life so much easier as well. So guys, if you like this video, please smash the like button because it will really help us grow. Thank you so much once again, and let's see what the market has in store for us this week. Thank you.